All right, so I think we're on a good course towards the end of the course. And what I'm going to do now is I gave you a review of financial risk management last week. Today I'm going to focus on the aspect of risk management which today I think still creates the most number of jobs, creates the biggest profit margins for the banks. That's where there are jobs. If there's no profit margins, there's no jobs. No one does these things for fun, right? And also it's the one area which is most relevant for the impact that AI, machine learning, and all of that is happening, is having in the financial sector. So there's a lot of things to focus on. And I'm going to do that by focusing on the very basics. And as usual, it all starts with a story. Am I sharing my screen? I'm not sharing my screen for the people on Zoom. Allow me to. Oh, there's something in the chat. Okay, so sorry, I need to, there's some announcement, some questions in the chat. May I ask where to find the second assignment? Well, it'll come to you, okay? Just read your email later today. The Reading Room webpage does not have the second assignment, right? And that's because I respected your mental health. I didn't want you to get all spooked up when you read the assignment and say, what the hell is this? That's why, okay? Yes? All right. Okay. So let me see if that shows. Okay, so I hope that's clear. All right. So now we can see what we're doing. I want to talk about credit risk, the part of the financial sector that still has the large number of jobs because it has a lot of profitability, and also there's a lot of innovation going on. And that's why I think it's a very adequate topic for me to discuss. It's very tricky to start, there we go, to do the first page turn. The rest I can do with this, but the first one I have to do with my hand, so. Okay. I want you to understand all of this from a historical perspective. There's a story I want to tell you. The story will take a long time, maybe half an hour. I can guarantee you that after that half an hour, we will learn enough so that everything that will follow today and next week will make a lot of sense. And it so happens that this event that I always use to talk about credit risk happened in 1983, and that was a consequence of the US-Iran war. 1970s. A little bit different from today. But we don't care about that. We care about the consequences of it. We already discussed last week how that oil crisis, the US-Iran war, the hostage situation in Tehran, and all of that had tremendous impact in financial markets. There was a lot of inflation. There was a lot of volatility. Banks went belly up at the rate of 6 per year for a decade. It was a mess. And then in the middle of all of that, derivatives came up as a way to protect financial participants from all the bad things that were happening in the financial markets. It's always like that. We saw that last week. Risk management is typically reactive, not proactive. Bad things happen, we brace for misery, and then we figure out how to fix it. So we're going to look into how these things develop. We're going to see the birth of perhaps the first derivative. in great detail, which was a swap that I will discuss. But before we explain the swap, I need you to understand the financial situation that the world was in 1982, which gave rise to the need of two participants in 1983. The first participant, which is going to be of biggest interest to us, is a company called Goodrich, B.F. Goodrich. You're young enough, and many of you will not know this company, but it was a tire company. Most of the car tires were made by Goodrich. Since then, they don't do tires. They do other things. They do military equipment. They did PVC for a while, okay? But they did tires for cars for a long time. Rabobank is another company that I don't know if you know. It's a Dutch bank. It's a very healthy, wonderful Dutch bank. They're going to be our two main characters in this little story I want to tell you. It's a financial story. And the financial story is as follows. We were in a situation where the world was in a very deep recession. You probably don't know about 1982. You probably know about 2008. 2008, for a while, it was discussed in financial circles whether it was going to be as bad as 1982. And people say, no, it's not going to be as bad as 1982, until Salomon Brothers defaulted. Then it was worse than 1982. But that just to give you an idea of the order of magnitude of what we're talking about. We're going to get into this financial situation, which is bad. And here was this company, Goodrich, that was then a tire company. Now, what happens when in a situation of financial crisis? What happens? There's decreased activity, and people, they spend less things on things they need less, and they spend the same or just a little bit less in the things that they need. And on food, for example, food is, you're hungry, you have to eat, right? You may buy cheaper things, you may not buy luxury items, right? So maybe people buy less truffles and more potatoes, but you have to still buy. But how about cars? You try to hold on to your car for as long as you need, right? Suddenly the idea of getting a new car is not so attractive. So car sales were down, big time, right? If car sales are down, what happens with tires? They're down too. So there was a company that had difficulties. Now, at the same time, there was this other participant that was a Rabobank. I will not go through what this bank is. I will just tell you that this is a Dutch bank. If you like road cycling, if you follow the Tour de France, they have a team, and they're well known in certain circles. They're public, but they are. It's a bank which is in the shade. It's not a bank which is very well known. And they had no problems whatsoever, but they had an ambition. The ambition was to get into the euro-dollar market. This is to get into basically trading dollars in European markets. That's what they want. And they both shared the same consulting company. That was Salomon Brothers. So they went to Salomon Brothers and said, well, I did what I want. Oh, okay, good luck to you. I want that. Oh, okay, let me see what I can do. Okay. Now, let me review a little bit the situation of B.F. Goodrich. It was a company that was just downgraded to BBB-. I know that you already know what this means, but it will be part of my course today. I'll explain to you what that means. They were downgraded BB-, and this is a point of situation. Car sales were down, and interest rates were at 11%. Now, let's reflect on this. What is the interest rate in Canada right now? You are experts on that. That was your first assignment. What was the number? You forgot already? Oh, I'm disappointed. Like 2%, 3%, something. There you go, right? And we are not in a recession yet. Very likely we'll be in a recession in the next year, very likely. Probably a bad one. Look at this, a bad recession, much worse than 2026, and interest rates are 11%. 11%. So if you have to buy a car, first of all, you don't have money. And second, if you're going to borrow money, 11%. You know what that means? Like, no, you don't touch a car. You drive that thing for... Now, I don't know those statistics, but I'll tell you, in 2008, which is very similar, if you look at the car sales numbers, you can invert the sales per year into how long you keep your car. You understand, right? Just the inverse. So in 2008, that number, in the car sales implied people were going to keep their car for 27 years. Not even in Cuba they do that. That's how bad it was in 2008. I don't know the numbers for 1982, but it was similar. So here's a company that had about $50 million in profit every year, and now in 1982 they had a deficit of about $33 million. These numbers are not too important. Okay, what's important to us is we have a recession with 11% interest rates, and from an economics perspective, that's a disaster. People were losing their homes; they couldn't pay the mortgage. Okay, and there was nothing that you could do with interest rates. I mean, the central banks could not lower interest rates because we had this 10 years of misery, oil-driven misery, right? And that's just the way things were. And derivatives did not exist, not the way they exist today, right? So a lot of innovation has happened in financial markets between 1982 and 2026. And that was the growth of the derivatives market. With its problems in 1987, as we saw last week, in 2008 with a big credit bubble burst and this and that. But this was before derivatives existed. Okay, so this was a double whammy. Recession, high interest rate. The company was in trouble. They had a line of credit. They were not going to go default, but they needed to finance their losses by borrowing. That's what they needed to do. They were looking for essentially $50 million in fixed rate financing. It's very important to understand why they wanted fixed rate. As we will see, they could get floating rate a little bit more cheaply, but floating rate means that if for whatever reason they get out of the recession, rates will be even higher. So they were interested, they were in search of fixed rate financing for their problems. Rabobank, on the other hand, was financially very strong, AAA rated, bigger rating than the government of Canada, for example, very, very good rating. But they wanted to get into the euro market. They are essential, well, they had a very big book of pension money. When you have pension money, you're not looking for fixed rate returns. You're looking for floating rate returns. Why? Imagine someone is managing your pension. Can you imagine having a pension? You have a pension, you'll have a pension. Maybe $5, whatever they take from your TA paycheck, but you have a pension, right? The thing is that pensions are supposed to grow like inflation. If inflation is high, they have to grow faster, and if inflation is lower, they're allowed to grow a bit more slowly. So typically pensions are indexed to inflation, so they have to be floating. A pension plan that gets a fixed rate income for the next 30 years is not going to do very well. All right? So Goodrich wanted fixed rate financing, and Rabobank wanted floating rate financing. They wanted to get into the euro-dollar market. They were in search of a variable yield. The difference is that Rabobank was a price giver. They say, well, I mean, they had no particular need. It was just part of their pension plan management. Whereas Goodrich was in need. They were a price taker. They needed to get out there and see what numbers they could get. So this was the situation. This was the market situation for Goodrich and Rabobank in 1983 when they went out there looking for money. One was looking to borrow, one was looking to lend. Goodrich could get a fixed rate loan as they wanted, $50 million for 12.8% fixed. However, if they go and get a floating rate loan, they would get Fed funds, which is 11% plus 50 basis points. Okay? That's what happens to many of us when we go shopping. What we like is the expensive thing, and we don't like is the cheap thing, right? Happens to you, happens to me, happens to you. You go shopping, oh, that's expensive. That's what happened to them. What they wanted was the expensive thing, 12.8. And the cheap option is the floating rate, which is not what they wanted. And the difference is substantial, from 11.5 to 12.8. That's 1.3%, which on $50 million translates into about $500,000 per year. That's a lot of money, right? Great. Okay, we'll leave that there for a minute. Then we go to Rabobank. And Rabobank, they could get a fixed rate exposure. I'm not going to say loan because they were lending. They could get a fixed rate exposure at 11% or a floating rate at 11%. I mean, Fed funds going up and down at 11%. Why? Because they have a very good credit quality. So there's no credit spread. We're going to get into this a little bit later. Right now, I just want you to understand the market that Goodrich and Rabobank had access to. You understand this? So this is very interesting. It's as if you go shopping with a buddy and said, I really like that, but it's very expensive. And this is very cheap. But the other person says, well, for me, the price is the same. I belong to a club. It doesn't matter. What do you do? So, well, you know what? You buy the expensive thing cheap. I buy the other stuff, and then we switch. The word is not switch. The word is swap. Understand? So that's what was proposed. Their common consultant proposed that they do a deal, and it's called a swap. It was one of the first swaps that was done, and we're witnessing in real time how this swap happened. So what they did is they convinced Goodrich to go out and get what they did not want, but was cheap, which is to get a loan from Savings Bank at Fed funds, Fed rate, plus 50 basis points. Okay? Remember, that's what they did not want. That's what you have to understand from there. Is what they did not want. And then Rabobank is going to go and get what they also did not want, which is to lend money at a fixed rate. They didn't want to do that, but that's what they did. But then a trust was created. A trust is think of it like a company that just has no employees, just has money. And this trust, what was going to do, is called the Morgan Guarantee Trust. What this trust was going to do is it's going to swap payments with Goodrich so that every year, every 6 months, it's not important right now, okay? There's a bit of a mismatch, but that's not important for us. It swaps payments. What it does is it's going to give Goodrich a floating rate, and it's going to receive from Goodrich a fixed rate. In practical terms, they don't really send money to get money back. They just look at the difference, and if you have to pay, you pay, and if you have to receive, you receive. Understand? It's called a swap. So every 6 months, it wasn't exactly like that, it's the mismatch, but I want to ignore that, right? What happens is, here you go, you owe me that, so today I pay you, tomorrow you pay me. And as you can notice, in the composition of the swap, with the fixed rate loan, with the floating rate loan, the result is a fixed rate loan. Is what they wanted, right? Look at the diagram. They're borrowing at a floating rate, but they have to, they receive a floating rate also from the trust. So those cancel each other out. The net result of all those three arrows there is that they pay a fixed rate to the trust. And what they pay to the trust, if you do the calculation, is they receive Fed minus a number X, which we will figure out what it is in a few minutes, okay? So they receive Fed minus X, they pay Fed plus 50 pips. That means that the difference there is 50 plus X. So the total rate that they end up paying for the loan is 11 plus 50 plus X. You see that? That's what they pay, 11 plus 50 plus X. So it's good, it's fixed. Is it better than 12.8? Well, if X is not too big, yes. We'll talk about X in a minute, okay? So this seems to work. And then Rabobank is, they didn't have any need, but said, well, we're gonna make some money for free. Because what Rabobank does is it receives fixed and pays floating. So what they receive fixed and they pay fixed cancels each other out. So they end up having a bit of a discount, I call it Y, on the fund rates that they will have to pay for their investment. Okay? So Rabobank is incentivized by Y% to enter into the deal. And Goodrich is incentivized by 12.8 minus 11 minus 5 minus X%. So if the X, a very small Y will convince Rabobank to do this deal, and a not too large X will convince Goodrich to get this deal. And the trust gets what? The trust is going to get, there's a mismatch there, right? Between the cash flows that go in and out. The 11% comes in and goes out immediately. So that's not, but Fed minus Y leaves at Fed minus X. So the difference is going to be X minus Y. That's what the trust is going to make. Okay, so let's go through this. What we have is the 12.8% minus 11.5. That gives 1.3. That's $650,000 per year of margin, which I want to split into X and Y. And I have here the financials. Rabobank makes Y, and Goodrich, the Morgan Guaranty Trust, the trust makes X minus Y. That's what you said. So as long as you can make these things work, this is what Goodrich will save. As long as you can make these things work, then everybody makes money. A few comments. First of all, do you understand all of these numbers here? Very simple. You don't need to know very much finance or math or anything. I just want you to understand the numbers. Yes?
They just have to pick X and Y so this whole system works.
Say that again?
The whole point is that we're going to pick X and Y.
Right, exactly. So now we start the negotiations, right? And the negotiation is a three-party negotiation. Rabobank shows up there and said, oh, I want Y to be very large. And then Goodrich said, I want X to be very small. And and the trust says, you know what, guys? Let's just make sure that X minus Y is bigger than 0. Right? That's the negotiation. Three-party. You understand that? Actually, it's not a three-party negotiation. Probably the trust does not want Goodrich to know there's a Rabobank and vice versa. Because the minute they know, then they lose their advantage. Information advantage, right? But we ignore that now. This is not a course on negotiation, it's a course in finance, right? So this gives us the parameters under which everybody makes money. And you see, I told you, after reading week, people make money and lose money. This is what we would call an arbitrage opportunity. Is this something that goes against the theories that we developed in the first half of this course? Well, not really, because these markets are very incomplete, right? And we already know that in incomplete markets, there's no arbitrage-free pricing. So maybe, but I don't want to get too involved in that. This is the real world. These are how things work in the real world. And you have a very good negotiator or a very good financial engineer, then whoever that is, whether it's Rabobank, whether it's the trust, or whether it's Goodrich, well, they will take the bigger slice of that pie. If you think you split this halfway, in equal parts to everybody, you can say that Y would be 650 divided by 3, about 200,000. The trust makes 200,000 per year, and Goodrich will save 200,000 per year, roughly. You understand what I'm saying? And they say, well, then Y should be 200,000, X should be 400,000, and then we're done. Right? So let's say that this is what they do. Now we need to understand one thing, and this is very important, which is there's a risk here that we haven't seen. If you look at this from a market risk perspective, there's no risk. You fix X and Y, and then you just wait. This ended up being an 8-year deal. So for 8 years, everybody's making money. What can go wrong? What can go wrong here? Don't tell me that rates go up or down, because we don't care. Rates going up or down does not matter. What can go wrong here?
Can't Goodrich default?
Goodrich could default. Rabobank could default too, right? The trust is difficult that it defaults because the trust has no expenses, so they will always have money, right? So Rabobank or Goodrich could default, but we already saw that Rabobank is unlikely to default. It's a bank, very good credit, so we're going to remove that from the equation. It is not a risk that we're concerned with. That's the part that we are concerned with. Goodrich could default. So that means that maybe the trust is not doing a good deal. Maybe this number that I said they make $200,000 a year is not enough. Maybe they're taking a risk which is a lot bigger than that, right? And this is the reason that made this case very, very famous. Because this was and this is the thinking. I want you to understand the financial argument, and then I will review the financial argument with a little bit of math. So we start to understand what's ahead of us and how we're going to think about credit going forward. So first, the finance of that. Imagine that Salomon Brothers, a consultant, had a very, very good financial engineer, someone who took APM 466 and really knew everything. He said, this is a very interesting situation, he says, or she says, right? Because let's focus on Goodrich defaulting. What will make Goodrich default? Bad business, right? And what does bad business means? It means no car sales. And that means high or higher interest rates. If rates go lower, then you expect car sales to go up, and then they will be okay, right? So they think that this deal will be exposed, will increase the probability of default of Goodrich if rates go further up. Are you with me? Great. Now what happens if rates go further up? I need you to see that. I cannot tell you.
I mean, Goodrich doesn't have any exposure to rises or drops in interest rates.
If rates go up, Goodrich could default. In fact, will probably default. But what is happening to my obligations as the trust? I have to pay Goodrich, right? That means I have no risk. Okay, this is very important because this is exactly counterintuitive. This credit risk goes against market risk. They're different. You may think by looking at this that if rates go further up, well, you lose money because you're paying Goodrich, right? Well, that's market risk thinking. But we already established that market risk does not affect us because we're going to get exactly that amount of money from Rabobank. And Rabobank is not going to default, right? So paying to a bankrupt counterparty is wonderful. The problem is when the bankrupt counterparty has to pay you, because they're not going to do it. This is what I need. This is what you need to understand today. We just climbed the first hill. You understand that? No, you don't. You do? Are you sure? Everybody understands that? You want to pay money to a bankrupt counterparty. Yes?
When you say exposure will go down, are you talking about the trust?
The trust, yeah. We'll only look at the trust, yes, okay? Because the trust is the only source of risk here. Goodrich has no risk. The trust is not going to default, right? Robobank has no risk here. The trust is not going to default. And Robobank is not going to default. Only Goodrich could default. That's the risk we're looking at. So, Hyun, you see that? No.
Are you saying that if Robo
I need everybody to see this, okay? I'm not moving until we see this.
so Robobank is not going to default, right?
That's right. No, AAA, they'll have lots of money, more money than.
So it will definitely pay the trust.
They will always pay the trust. Yeah, we're making that assumption. That's right. Yes. The only obligation that could be broken is this one here. That's the only one. And that will only happen when rates go further up. But if rates go further up, we're never receiving money. We're only paying money. So we don't care. Do you understand? All right. Imagine you take a loan from a friend and the friend goes bankrupt. Well, sorry for the friend. But now imagine that a friend borrowed money from you and the friend goes bankrupt. You're not getting your money back. You see the difference? You have not done a lot of lending, I can see. When you lend is when you worry that the other counterparty is going to go bankrupt. When you borrow, if you borrow money from someone and the other person leaves the country, that's simple. Right? If you lend money to someone and they say, where are they? Their WhatsApp is not working. Now you worry, right? So the risk here, the credit risk here, is that rates go down. But if rates go down, they're going to sell tires. They're going to be okay. It is not that risk has disappeared. What we're noticing here is that there's a very interesting relationship between the risk factor driving your credit quality and the risk factor that affects your credit exposure, which is how much money you can actually use. And here they go against each other. So this was considered to be a good deal with very low risk. And that's the reason this swap happened.
So what if rates go up by an amount that is less than X? So now Goodrich is still paying to the trust a higher amount.
X is a small number, is 20, 30 basis points. So you are right, there's a chance. But see, if that happens, then that exposure will be now, I will define exposure next week actually, okay? But for now, we just see that the amount of money we will lose is going to be very, very small because those numbers are going to be very, very similar, right? So of course, if they go up just a little bit to make those two lines the same, then, they went bankrupt, they have to pay me 5 cents. Okay, 5 cents I lost. You understand what I'm saying? So the risk is when X is very large. Sorry, it's when Fed funds are very high. That's the risk. That's what will cause a default, but then, you still pay. You still pay the default counterparty because the judge is going to come and say, you have here that you have to pay, so you have to pay because the bondholders are waiting, right? You still have to pay. If your counterparty goes bankrupt, you still have to pay. If they have to pay you, you are not going to get that money, right? You understand? This is very important. This is what I want you to understand. I'm going to spend the rest of today just playing with this concept and mathematizing this concept and doing what I usually do. But I need you to understand this financial situation, which is very, very interesting. Yes.
Sorry, how does the floating rate work?
Okay, so Fed funds. So very good question, by the way. Okay, which I will answer very quickly. That deserves a whole course.
Right.
Okay, but I'll answer in just a few minutes. First of all, these Fed funds would be is the funds that the Federal Reserve Bank charges its member banks. So that's the rate that the Bank of Canada, for example, will charge its banks here. You probably know that every once in a while the Bank of Canada meets and they raise rates, the lower rates. You know, in the United States, Trump has been at war with Larry Powell because he wanted rates to go down, and Larry Powell said, no way. Those are the fund rates, okay? And they are done by the Federal Reserve Bank in New York. These are American numbers, right? But you could also say, because this is for this specific case, but normally these are numbers which could be indexed to, for example, the rates that you calculated on your assignment number 1. This could be the 3-month rate that you calculated. Well, you didn't do 3 months, you did 1 year, right? But you could have done 3 months. So let's say those are and then people will calculate those rates like you did, just more accurately. And say, oh, it's time to settle the swap because the year is up. And then someone hires one of you and says, give me the number. You calculate the number with the same way you did in assignment number 1. And then you get that number and say, oh, I have to pay. Oh, I have to receive. So there is a number that will trigger this swap payment. And the number is either, depends on how this Fed is referenced, is either the published rates by the Fed, the central bank, or the rate implied by the bonds which are traded in the market. Okay? You picture yourselves there in this desk and say, oh, this is making money? Right? So you do this, and then for 8 years, your firm, not you, your firm is making $200,000 a year. You do a deal like this every week, that's $5 million a year. That's a good business. That's credit. And credit has 2 phases. One is credit risk, which is where I will focus on, but there's also credit trading, which we will also focus on today. Actually, credit, no, I will do that next week. We'll do a credit trade, a beautiful, beautiful credit trade. We'll do it next week, I think, okay? Are we good? We've climbed the first little mountain. Okay, so what I want to do now is we understand that, and we understand the benefits of doing things well. We can see here that the real risk we have is that rates go actually down, because that's when we expect to get money from Goodrich. But we think that if rates go down, they're going to sell more tiles, so this is going to be okay, right? But that's my risk factor. And this is something which will be mathematized next. I will do this next week. This week, now I just want to focus on this new concept we developed, which is credit. Now, I want to tell you a beautiful story, another story. So we're done with my first story. I thought it was going to be half an hour. It's been almost an hour. I think it's worth it, because that's how credit started, by the way, okay? With that particular example in 1983. Now, I want to tell you a deal. This is a deal from, I think, 2015, 2010, something like that. And this is how credit is today. It's very different. And this was a deal that a Bank of Nova Scotia did with Cencosud, a supermarket chain in Chile, a Loblaws equivalent. What they did is this. Scotiabank before, Scotiabank is you know Scotiabank, right? Yes, Bank of Nova Scotia, yeah. It's a bank which is a very big bank in Mexico, in Chile, Peru, and Colombia. Very big. It's our Latin American bank. And they got into this Chilean business before they were a bank there. What they did is they did a deal with a local supermarket, think of a Loblaws. I've actually been in the supermarket, Jumbo, it's like Loblaws. And what they do is, shoppers, when they go there, when they go to the checkout counter, they can ask for a loan up to $300 cash. You buy your milk, your mangoes, your strawberries, and then say, well, give me some money. And then the way it works is as follows: when the people go there, the supermarket already has their customer profile set up. Like you have, anybody's member of these loyalty programs, like President's Choice at Loblaws, for example? Why do they have these loyalty programs? To know who you are, to do customer profiling, right? Do you know the famous story? Walmart was going to be sued by a man who Walmart sent these pamphlets to their home, and they were addressed to his daughter, 14, 15-year-old daughter, something like that. And he got very upset because in these flyers, Walmart was advertising baby products, like a stroller, bottles, baby formula. So the man got very upset and went to Walmart. Actually, attempted to sue Walmart because he said Walmart was trying to encourage his daughter to become pregnant. You know the story? His daughter was pregnant. Walmart knew it. He didn't know. Customer profiling has a way of knowing these things, right? Because they see what you buy, and then they hire people like you, and then that data has tremendous value. And you probably know that pregnant women is the ideal for any merchandising activity because they have the biggest price flexibility, right? So that goes to show how important these loyalty programs are, because they give a lot of very good information. There was a time when Loblaws was hiring people from this class. Loblaws set up a very big data campus in Brampton. And I know at least one person from this class was hired by them. I know that. That experiment did not work, but that's what they wanted. That's what they are doing. They are collecting information. Loblaws, as you probably know, Loblaws has three businesses: supermarket, which is where they get your data; Shoppers Drug Mart, the biggest pharmacy in Canada, which is where they get the vital data, medical data, the most valuable; and then the bank. President's Choice Financial, which is how they commercialize that information. Right? This is the new businesses. This is what's happening new in society today. So Scotiabank was not like Loblaws, but it's part of the same type of novel finance. By the way, I try to encourage all my students that they are very well aware that finance is spreading so far, especially when it comes to credit, that now Apple is a finance company. They do payment systems, Apple Pay, for example, right? Loblaws is a financial company. What they do is customer profiling, and then they utilize that information for financial purposes. They will give you a mortgage, and they have better information about you than CIBC, right? Because the data they have from your program. So this was the deal. Scotiabank would have access to that information, very valuable information, so they can make decisions to give a loan very, very accurately with very low risk. We don't know what that is yet. I'm just giving you another little story, very modern. And the way that works is when you say you want a loan, then the supermarket and Scotiabank, they exchange some information. We don't know what that is. They know. And then the bank has 5 seconds to give a response back to the supermarket and say yes or no. This is modern day credit. And it's an exercise in machine learning. And this is not something I'm going to talk about here. What I will talk here is only the old stuff, which is what you need to know, because when you know the old stuff, the rest is just machine learning. Okay? So I just want you to be aware of this. This is the new credit risk, but I'm not going to do that. Okay, so I have some reflections here about why this was a good deal for Scotiabank. I don't want to talk about that now. It was a very good deal for the bank. I have some reflections on the data that's going on these days and the importance of the data, this and that. No interest. I'm just going to go through that. It really is very nice. But I deliberately don't want to talk about that. And this is about cybersecurity, and it's all very, very interesting. But what I want to do is I want to go right now to the crux of the matter, which is to talk about credit. So we're going to take a 10-minute break, and when we come back, I will tell you how credit works. We're going to now start from the beginning. Story's over. We're going to go back to the first day of classes now. And I remind you of the formula we saw, which is if I have a series of cash flows in the future, they can be priced today according to that. We saw that the first day. All right, so a little reflection is that formula is true, assuming the payments happen for sure. But what if the payments happen with a probability which is not 1? What do we do? Well, if this formula expresses the number of payments, the amount paid, and the time at which these payments will occur, we already know that the interest rate is a made-up number. It's a mental construct. You became experts on that in assignment number 1. So as long as these payments all happen with probability 1, then we're good. This formula will be true. If the probability that these events happen is not 1, is something else, then we may consider a revision of this formula. So if I introduce a number, which is the probability that this payment will happen, which is what we will call the solvency probability, then it seems that it's reasonable that we would value this series of cash flows as follows. We multiply each of the discounted cash flows by the probability of solvency, by the probability that the event will happen. Does it make sense to you? Doesn't it remind you of a situation where we already used probabilities before and we were wrong? We've learned one thing in the first half of this course, which is that using probabilities to price financial instruments can lead to errors, right? Okay, this is going to become very important for us now. But allow me to sweep this under the rug, and I'm going to say that we're going to be happy with this formula as long as this number Q, this probability, is a risk-neutral probability. How's that? We don't know what that is, but it should suffice for a few minutes, don't you think? Allow me to say that. This is going to be true with a footnote that we care where these numbers Q come from. We remind ourselves that the 50%, the 33-cent game with the probability of making or losing $1 with 50 cents was wrong, right? So we don't want to make that mistake anymore. We should have graduated to a knowledge where those mistakes are just not made. So let's just be aware of that for a minute. I don't want to focus too much on that just yet. In 10 or 15 minutes, yes, but not right now, okay? And if we look at this formula has certain symmetries which we like. What we would say is that, for example, you have a fixed value, like in the case of a bond, you buy it, then the payments will have to increase if the probability of solvency is decreased. Right? This is what happens when you get a mortgage and your credit is bad, you pay more. So yeah, we have that. And this increased amount that we pay is what's called the credit premium. You pay more for bad credit. What we could also see is that the value will decrease if the probability of solvency is low. So the credit quality of my counterparty will affect the value of whichever asset I'm doing. So for example, in the case of a swap with Goodrich, that swap will have a value which is less than the value of the swap with Goodrich, which has better quality. Okay, that's another interesting symmetry that we have here. Okay, so let me now talk about risk neutral pricing. What does that mean? So we've learned that this is something you have to be very, very careful with. And when I talk about the probability of solvency, let's be very practical now. What does that mean? Say I give you, I borrow money from you. What's my probability of default? What's the probability I give it back? It's a valid question, but no one knows the answer. No one knows the answer, because that is in a sample space, which, what information do you have about that sample space? Maybe you can, you can see how many loans I've received and how many I've paid back. You could do that, but if I'm still here, probably I paid them all back. Right? So, and one of the things we will see today is that if you default once and you never come back. Bankruptcy is a permanent event. So by definition, every counterparty has never defaulted. Therefore, if you try to approach the calculation of a probability of default from, say, historical data, everybody has perfect credit. So it's not going to be very useful. And this is good. We are lucky because it will, as you will see, almost all of the ways in which I can calculate the probability of default of anybody, people or institutions, is going to have to be risk neutral. There's no other. So that's good, and that's why I don't want to spend too much time on this. And today we're gonna see that. You will see that. So default occurs only once. That's something which is, you can say, well, you may know someone who went bankrupt, and then you go through, I think it's 2 years of something, of pain and misery, and then you recover. But when you recover, you are a different legal entity. You may know of a company, for example, GM, General Motors, defaulted in 2008. But the company that came up is also called General Motors, but it's a different company with different sets of liabilities. So from our perspective, default is permanent, okay? They never recover from defaults. They just, it looks like they recover, they're actually different companies, maybe with the same name. So now all of this is now going to be, a lot of this is going to be revealed with a very simple consideration. And I'm going to be a mathematician, which means I want to go to the world of make-believe. I want to go to the world of ideas. And what I'm going to do is the following. This number, this probability of solvency that I mentioned, it's a number between 0 and 1. So what I can do is I can create a new number, which is the negative of the logarithm of that number divided by the time at which I'm considering the possibility of default. Okay? It's my definition. Logarithm of a number between 0 and 1 is going to be a negative number. I make it positive with a minus sign, and I divide it by that. So that number is well defined and is unique. So I can do that. Being a mathematician gives me a license to create definitions. And that's mine. But it turns out that this is not just a definition. This is a number which is actually very useful because it allows me to rewrite my cash flow valuation formula as follows. I remind you, I was multiplying the payments by the probability of solvency. The probability of solvency was Q. So from that expression there, I see that Q is the exponential of minus h times t. So I can group the h and the r together, and what that does is it gives me the same cash flow valuation formula we always had, but with a different rate. With a different rate. It's called the hazard rate. It's also called the credit risk premium. So the higher the probability of default, the higher this number h is going to be. Correct? And that is what we call the credit spread. Now, this is very interesting for now because this credit spread, is that something you could calculate? Now I'm talking about assignment number 2, all of a sudden. I give you a company, or you pick a company. Bank of Nova Scotia, we talked about them earlier. What's their what's their credit spread? Well, Bank of Nova Scotia has bonds. They are in the same database where you got your Bank of Canada bonds. So you take one of their bonds, you don't need all of them. This is not like assignment number 1. So you can calculate R plus H. That's what assignment number 1 does. I hope you did not delete your Python code. I told you to keep it. Yes, you have it? Good. So if you replace your Bank of Canada bond price with the Scotiabank bond price, what are you going to get? R plus H. Right? But you know R. What is R? R is what you obtain in assignment number 1. So you take the difference. That means that all of you can calculate H. You already have the code for that. Am I right? Yes? Yes.
I'm just curious, if
Yeah.
you use, depending on the instrument you use to construct your risk-free term structure, you're gonna get different H's, right? So I'm curious which.
Sorry, I don't understand. Say that again?
So depending on what instrument you use to construct your risk-free.
Depending on what?
Instrument.
Instrument. Oh, a bond.
Instrument you use to construct your risk-free term structure, you know, if it's like OIS discounting.
Right, okay, yeah,
you
yeah,
get a
okay.
different hazard rate, right?
Yes,
So-
okay, now you just became a fixed income trader. Just that's how you do, right? You say, oh, I can, the swap rate is lower, so so you buy bonds, sell bonds, reproduce a swap, and then you get an arbitrage. That's what you're saying.
I guess.
Yes.
I was curious which one, I guess, which instrument do you choose to calculate your hazard rate? Which is the most appropriate choice?
Well,
I guess it depends on your.
here the bond.
Okay.
Here the bond. Okay, here the bond. The thing with, for example, if you do a swap has a lower credit risk profile. And because of that, swap rates are typically a better measure of credit, but this is not something that I want to address right now. I prefer to stay at that level. So I want to say bonds are good enough, and bonds will give me the hazard rate. So all of you here, you can calculate the hazard rate, at least taking into account the bonds in the same website where you got the Government of Canada bond price. You understand? Yes, we're good there? Yes? Great. So now that's the credit spread. You can all do that. And I told you that assignment number 2, you're going to have to calculate the probability of default. So let me tell you how these two are related, okay? But now, before that, I want to just give you some. I'm going to try to in these lectures. I have some exercises that I want to review. So this is an exam question from the PRM exam. The PRM exam is the Professional Risk Manager's exam. I was involved with that for a while, and they give us this table, which is a 1 year forward zero curves for a credit for different credit ratings, which I will explain in a few minutes. And then it says a senior unsecured BB rated bond matures in exactly 5 years and is paying an annual coupon of 6%. I'm asking you to use this table to calculate the 1 year forward price of the bond if the obligor stays at BB. So the answer to that is we use this formula that we just saw here, except we're going to use, like people in finance do, which is annual compounding, non-instantaneous compounding. So the value of that bond is exactly that. It's a consequence of what we just described. All right. Okay, let me move on. Okay, so I'm going to then to tell you how important this is. I'm going to consider a very, very simple. It's the simplest credit model we're going to see in this course. The simplest. We're going to see it now, and we'll make it much, much better. We'll make it a little bit better later today, and much, much better next week. But I'm going to start with a very simple model, and it's one in which my counterparty is going to be in only two possible states: default or solvency. No BB, BBB, nothing. And on top of that, I'm going to assume that the probability of default for any period, say 1 year period, is the same. Very, very simple. Okay, so only two states, solvency or default. By the way, this is always the case. You're either solvent or on default. Okay, so this by itself is not an assumption which is restrictive in any way. This is the one when you assume that you only have two states and the probability of going from solvency to default is the same on the same 1 year on different 1 year periods, is when you're making a very restrictive model. And I like this model because it's going to be very useful for us. You understand what I'm saying here? Okay. So you have a probability of default, or whatever it is, 2%. And it's 2% this year, 2% next year, 2% in 3 years. Always 2%. You don't get better, you don't get worse. Very simple model. So that's what I'm saying. The probability of being solvent at time t plus 1, where t is in years, for example, conditional that you're solvent at time t sub I, is always the same. I'll call it q. Great. So if that's the case, then we can see that this implies the probability of solvency after a period of time, any period of time, is q to the power ti. Okay, so is that clear? What's the probability of being solvent? Say this is, so 1 year, okay? Q is 1 year. What's the probability that you're solvent in 2 years? The probability that you're solvent in the first year. And then the second year is like flipping two coins, 2 heads in a row. Or 3 heads in a row, or 4 heads in a row. And that goes also to fractional times. If the probability of being solvent in a year is q, what's the probability of being solvent in half a year? It has to be the square root of q, right? So the consequence here is that the probability of being solvent at time t is q to the power t. So if that's the case, the credit spread is constant. But this doesn't end here, because if the credit spread is constant, we actually have a very good result in our hands. I'm going to rewrite everything that just very simple, right? I'm going to rewrite it with a little bit of mathematical jargon. I'm going to be very pedantic. I'm going to write my model as follows, assuming I have a counterparty whose credit quality follows a Markov chain with only two possible states, solvency and default. Who does not know what a Markov chain is? Anybody else? Only you? Okay, well, I'll show you. It's very simple. The Markov chain is you are in solvency or default, only two states. And at every state, you can go from one to the other with a certain probability. And the probability, because you can go from any one of your states, in this case 2, to any other of the same two states, in this case 2, is given by a square matrix. And the square matrix has probability numbers on its rows, which have to add up to 1, because from one state you are forced to go somewhere else. That's what a Markov matrix is, and that's what a Markov chain is, in very, very simple terms. Some of you may have seen a more abstract definition with who knows what. That's not what I need. I just need this. So I can say that a Markov chain with this matrix Q 1 minus Q and 0, 1 leads to a constant credit spread. It's a theorem. Good. And the spread is minus the logarithm of Q. Okay, so let's pause here for a minute. Because if you went to the website and you get the bond, you just need one, the bond for the Bank of Nova Scotia, and you assume this model, what's the probability of default of the Bank of Nova Scotia? It's 1 minus Q. But what is Q? Its negative logarithm is the credit spread, but you just told me that you can calculate the credit spread. So you calculate the credit spread, as we discussed 5 minutes ago, and then you take the exponential of the negative of the credit spread, and that's the probability of solvency. Remove 1 from that, that's the probability of default. You're done. Do you feel powerful right now? From that website, you can calculate the probability of default of anything that issues a bond. Just one. And by the way, is that a risk-neutral probability of default or not? It's risk-neutral because it comes from a bond price. There's no other. We just climbed another hill. And that was easy, because all the work was done already in assignment number 1. What's the probability of default of the country called Canada? Can we do that? It's a bit more difficult, right? Because to do that, we need a risk-free rate. So you can always calculate the probability of default of anything if you know the risk-free rate. Right? Okay, so there is ways to do that, but strictly speaking, this thing we have seen only works for companies in a country where you have the assumption that the government will not default. But let's continue, because there's more things of interest here. So we just saw that in our model, the credit spread is constant. And by the way, we can calculate it. And by the way, that gives you the probability of default, right? Okay, good. But typically this credit spread is not constant, which means what? Which means that if you want to enhance our toy model to make it relevant, you have to make it a bit more flexible. How do you think we make it more flexible? What assumption did we make, which is very constraining? We made 2 assumptions. There's only 2 states, and the transition probability is constant. So there's 2 things that we could do. We could remove one or the other. We can say there's more than 2 states, or the probability is not constant. Right? Okay, so next week, each of those 2 choices becomes 2 commercial models. One is the credit matrix, the other one is the KMV. We'll see that next week. I don't want to do that this week because we still have some concepts to derive. So I want to stay with what we're doing I'm going to make it very practical. And what I'm going to do is I'm going to turn this, I'm going to assume more than one credit state and see how far we go with that. Okay, now, before we do that, I want to make you now really, really powerful. And what I'm going to do is I'm going to apply everything we just learned to sovereign risk. I just told you the probability of Canada defaulting we don't know. But there's one that we do know, and there's lots of very interesting consequences that we can draw from there. Now, before I tell you that, I need to introduce now a new term, something that has not come up. It took 1.5 hours for this term to come up. It's a very important term. We'll be spending a lot of time with that next week. And it's the recovery rate. So I'll explain that a little bit. I'm going to take you to Europe, 2015. Oh, no, sorry. Yeah, 2015. I don't know if you remember what Europe was like in 2015. There was a big word in Europe in 2015, and that was Grexit with a G. Anybody remembers that? Grexit with a G. Then it became Brexit with a B. That was in 2016. But Brexit was, there was the, as a result of the credit bubble, I'll save all of this, Europe was a big financial mess, very big financial mess. And there was speculation that Greece, the country Greece, would leave the euro. Greece is in the euro. They would leave the euro and they would develop or bring back the drachma, which was their previous currency before the euro, and they would leave the European Union. And that was called Grexit. Now, let me recalculate what Europe was using everything we've learned right now. The advantage of Europe is that I can calculate the credit spread of every country because they all use the same currency. The problem if I want to do, for example, the credit spread of Canada comparing to the United States, they're using different currencies. And the exchange rate is not constant. This is a little bit of a mess. So I don't want to, but in Europe, I don't have to do any of that. I'm going to assume that German bonds were the risk-free because they had the lowest rate. So, well, they are the risk-free. And now I can benchmark every other bond in Europe to the German bond because they have the same currency. Okay? If you can take this anywhere else, but then you have to deal with the currency exchange, and I don't want to do that. So, in the case of Greece, I have a bond. I'm going to assume there is no coupons, so a certain notional N. Then I have a risk-neutral probability of solvency or default. I call it Q for the solvency, right? And then I have to introduce a recovery rate. If I don't do this, then here I'll be making a very big mistake. And especially for countries, this is how it happens. When a country goes bankrupt, what they do is they don't just not pay. They pay you a little bit. For example, 80 cents in the dollar. A country that has done this several times is actually twice, Argentina. Argentina has defaulted twice. And every time they default, they say, well, I know I have to pay you this, but will you settle if I pay you 80% of that? What are you going to say? No? You don't have a choice. So you negotiate and you typically say yes. That's called a haircut. And from our perspective, that gives us a new term which is called the recovery rate. Okay? And I need to do that because for companies, you can have companies there where the recovery rate is 0. My favorite company there is Blockbuster. Do you know Blockbuster? Have you heard Blockbuster? Any of you went into a Blockbuster store? Maybe you did as a little girl, maybe? Yes? Okay, well, they are one of my favorites. They went bankrupt and 0 recovery rate. Nothing. They had a massive real estate portfolio, highly levered, and during the 2008 financial crisis, their bonds were to 0, nothing, no recovery. But usually there is one, okay? So if you have recovery, that has an impact. It's something that we haven't seen yet. So let me introduce it now. All of this will be done systematically next week, and we'll develop commercial models that for sure they need to take all of these things into account, for sure. But for us now, what I want to do is, an assumption of 50% for the recovery is very typical. There are historical studies that we'll see next week where 50% is close to the truth. So let me then reflect on how this would work. We'll have to adjust the cash flow valuation formula because in the case of default, I don't get zero, I get something, right? So the cash flow valuation formula is going to look like this. Sorry, lots of variables here. So let me go through them very carefully, one at a time. So the value of my bond, in the case of sovereign risk, is two things. First, the value that I get when there is no default. And when there's no default, I still multiply by the probability of default because that affects the valuation of my cash flows. But then I have what happens when I default. I get a recovery rate. So with a probability Q, no default, I get the full value. And with probability 1 minus Q, I default and I get the recovery rate times the full value. That's the cash flow valuation formula. Okay? Good, so we're done. Because with here, what I can do is I can just see that the credit spread is as before. This is what you calculate using your assignment number 1 Python code, right? That's what you would calculate. So then you can plug, you just bring the V into the first equation, divide by all the n's, just get rid of the n, and you have an equation that you can solve explicitly. This is the answer. So this gives me a direct relationship between the credit spread, which you told me you can calculate, and the probability of solvency with a recovery rate, which is arbitrary. If I take R to be 50%, then what I can do is I can just take this everywhere to every country with the same currency and calculate the probability of default. So in assignment number 2, I'm asking you to take a company, not a country. In a company, you don't have this issue because the companies use the fiat currency of the country, and the country has a risk-free rate, which you already know how to calculate, and I suggest you use Canada because you already did that. And you have plenty of companies in Canada to calculate probabilities of default for. But if you wanted to calculate the probability of default of Boeing going into the United States, go ahead, you can do that too. You're very powerful now. Very powerful. Okay, so one thing that you can do, for example, is I did this exercise once. In 2012, when the credit crisis was just beginning to bubble up in Europe, I went through 3 countries, Spain, Portugal, and France. They have a credit spread that you don't even need to calculate, by the way. This is published in the newspapers. Back then, newspapers tracked these numbers every day because they were very scary. But what no one did is tell you what these numbers imply. But now you can do that. We just saw the formula. So for example, in the case of Spain, with 419 basis point credit spread, that's a probability of default of 8%. 8.2. Portugal, with a credit spread of 909 basis points, huge. It was 17%. France, even France, had a credit spread of 135 basis points, which implies a probability of default of 2.7%. And you can do all of this using a baby model that we just developed here. But believe me, this baby model is great for intuition. Some of you will become very active doing credit wonders. I can guarantee that your first approach to anything you do is going to be with this model. It's very intuitive and it's very simple. Do you understand what I'm saying? Yes? And for assignment number 2, that's the one I want you to use. If you want to use the one that I'm going to tell you now, which is the more sophisticated one, by all means, I would not do it. Okay? But I want you to understand it. And that's why you also have to do something. Some of you, I know that some of you are very, very self-driven into these issues in finance, and you will be, I know that you will really enjoy doing not the 1-factor model, which is this one, but doing the 8-factor model. And you can do it, you can all do it, if you wanted to. So I want to show you how you would do that if you were up to that, okay? But for most of you, I mean, for the rest of you, if you want to do this in your assignment number 2, I'm totally fine. And as I already mentioned, what I value in assignment number 2 is going to be the way you explain it. Which, as will become clear in my last lecture, your professional success is going to be more reliant on how you explain what you do than what you actually do. And this is not whether it's fair or unfair, that's just the way things are. Okay? So that's great. Okay, so now let me take this and make this more accurate. And for that, what I'm going to do is I'm going to introduce the situation where I have more than one credit state, n credit states. So if I have n credit states, a Markov chain now is going to look like, well, I have n possible situations, and I can go to n possible situations. So I use a matrix to define what those probabilities are. This matrix is not only going to be a convenient way to organize my information, it's also going to have arithmetic properties, as we're about to see. But for now, it's just a way to store my information. Maybe I don't know how to go from P31 to P25. I don't know. But that's besides the point. This is the model I'm following, okay? In the first example, there was only one parameter, Q, that defined my 2x2 transition probability matrix. Here I have many, many parameters. Since all of the rows are up to 1, and the last one is the default one, in which I do not recover from default, what I have is n minus 1 squared parameters. Okay, but that's besides the point. We don't care too much about that. So they all add up to 1. This is what makes them a Markov matrix. These have a name. It's called a Markov matrix. Okay, and from here is where credit rating agencies come up, because what a credit rating agency is, one aspect of it is just a Markov chain. Okay, that's what credit rating agencies do. There's a number of them, and they take a bond issue and they rate it. And not only they rate that issue, but they also tell you how those ratings are related to each other, and they give you the transition probability matrix between the ratings and all that. We'll see how the commercial models work next week. Okay, the S&P rating system, for example, has 4 investment grade. This is the way to describe them. We don't care. We only care about the math. And 4 non-investment grade levels. And we can see that the drama in the Goodrich case is that it was on the brink of going from investment grade to non-investment grade. If you're non-investment grade, that means that the big investors cannot buy your bonds. At that point, the credit spread really jumps. There's a bit of a discontinuity there. And when I say that the big investors do not buy their bonds, it's because they're not allowed. For example, pension plans are typically not allowed to hold bankrupt bonds. There's a policy that says you can't. But it's a good deal. I can't. Right? And many of these, if you are downgraded to BB, then many of your bond investors will just have to sell the bonds at any price. could be terrible. You can have people buying your bonds at 2 cents in a dollar. But that's the real world. That's how things work in practice, okay? So, yes.
Is there a reason why the investment grade and non-investment grade is like separated between like triple B and double B?
This is the way someone did the investment policy years ago, and it's been adopted, and that's a lot of that is tradition. But of course, the rating agencies are aware of that, so they use harsh parameters to go from one to the other also right there. So this is the way the financial markets have worked for the last few decades, and that's how they. So you can see that it's a self-consistent model. Okay, and I have here the S&P transition probability matrix. I just want to go beyond that. I don't. And now what I want to do with this is I want to consider what happens with this new model we just came up. For those of you who know Markov chains, this is not a surprise. You already know this. But for the one person who did not see Markov, or if you did not know Markov chains and you didn't want to raise your hand and tell me, this is something which I think would be useful for you to learn. So we know that Pij is the probability, transition probability, the probability that I am in state J conditional that I was in state I at the beginning of that period, which is typically a year for credit, all right? And that's how I do the matrix. And this matrix does not change over time. It's always the same. It's always the same. Okay. No, by the way, when I say it's always the same, I don't mean that S&P or Moody's will every so often come and say, oh, I changed the matrix, now it's this one. They do that. But it's not that the matrix will change every year. Or it's a calibration recalculation, and you're familiar with that, right? You can assume your model has these fixed parameters. Today you think there are 2, tomorrow it's 3. It's not that the model will change, it's that the calibration will change. That's all, right? So how do you calculate the probability that you go from state I to state J, but in 2 years, not in 1 year? How do you do that? Well, you consider all the intermediate stages you can go through. There is n of them. I call them k. So the probability you go from I to J in 2 years will be the probability that you go from I to k and from k to J, which you obtain by multiplying. And then you sum over all of the possible intermediate steps k that you take, right? And if you remember your elementary matrix multiplication formula, you recognize this. This is the elements of the A squared matrix, right? That's how you multiply matrices. You see, Markov matrices are not only a good way to store information, they also have arithmetic properties. It happens very often. Okay? Matrices are wonderful because not only are good ways to store information, but sometimes they also have arithmetic meaning, like in this case. And by the way, if I ask you to calculate the probability of default in 30 years, given that I give you the 1 year transition probability matrix, how you do that? You take the power 30 of that matrix, right? So that's how Markov chains work. And if I ask you for the quarterly transition probability matrix, what's that? Well, it'll be the fourth root, a to the power 1/4. At which points I need to pause and ask you if you know what that means. Have you taken square roots of matrices? You all have. You all have. Sadly, you all have, and I forgot. Whoever taught you that didn't teach it properly. It's one of my pet peeves when I teach the credit, that people people don't know matrices. Okay, so I'm going to pause. I need to. You all have seen it. I'm pretty sure. I'm pretty sure. And it was probably taught to you the wrong way. Okay, no offense to my fellow math teachers, but linear algebra is one of those things which is taught wrong by almost everybody. It's very sad, but what can we do? That's why we have a course in Math Finance, to learn finally what a matrix is, don't you think? All right, so show of hands, who has done the square roots of matrices? Okay, all right. Who has done eigenvalues and eigenvectors? Okay, didn't they show you when you did eigenvalues and eigenvectors? Because that's how they do it. It bothers me, but that's how they do it. Didn't they tell you, maybe in passing, that you can take any function, really, of a square matrix by keeping the orthogonal decomposition and then affecting the function on the diagonal of the matrix? Didn't they tell you that? Well, they probably told you and you forgot. Okay, because that's how they teach it. And it's not wrong, it's right. Problem is that really is not what the square root is, or the logarithm of the matrix. You can take really any analytic function of the matrix, right? It has to be analytic though, okay? Important reason, as I'm about to show you. You're gonna see you're gonna become experts in linear algebra suddenly, okay? So that's probably how they did it, because once you can diagonalize the matrix, then it's a theorem that it shows that whatever function you apply on the matrix, you keep the orthogonal decomposition, and then you apply the same function to the diagonal elements, and then you're good to go. Right? So you can take square roots, fourth roots, anything you want. Logarithms, exponentials, sines, cosines, anything. Right? Complex, real, doesn't matter, it's the same. But you don't really understand why that's done that way. And by the way, that's a very expensive way of calculating square roots of matrices, because that requires lots of calculations. There's a simpler way, and that's this one. Here I'm taking powers, but you can calculate this with any analytic function. You know what analytic function is? An analytic function is one who's equal to its Taylor series, right? So let's think the right way, and this is what I want you to learn. Can you do a polynomial of a matrix? Yes, you told me. You know how to do squares and powers 3 and powers 4, right? And you can multiply by a number, and you can add and subtract, right? So everybody could do polynomials of matrices, right? Can you do an infinite degree polynomial of a matrix? So why not? I do it until I get tired, and then, right? And then you just approximate by truncate it. Well, when you truncate, what happens? Say you do the first 100 powers. Power 101, I'm tired. My computer is tired. I stop. What happens? Well, your error is going to be proportional to a to the power 100, right? A to the power 100? Yes? That's Taylor's theorem. You have seen Taylor's theorem, right? And I hope you learned that right. So the error is about a to the power 100. So here the error we're making is like a to the power 100. If my matrix A is very big, a to the power 100 is a very big number, right? Right? But look at the formula. Do you recognize there Taylor's formula? Look at the top. I'm talking to experts, so that's why I'm not going through this in great detail. You have seen this formula. If A is a number, not a matrix, if A is a number, that expression is exactly correct, and you have all seen it. You have all seen it, because that's the Taylor expansion for the power. You recognize the derivatives at, okay? And it's a Taylor expansion around the point 1, right? And it converges as long as what? Who can give me the radius of convergence of that sequence?
Is it like a minus 1 absolute value less than?
Yep. So if a minus 1 is less than 1, you're good, right? At 1 we have a singularity. Yes? And by the way, I could do the same for the logarithm. It's all the same. It's all the same, around 1. So you've seen that, if a is a number. You're with me, right? Well, and the reason is that the error is a minus 1 to the power m, where m is 100. That decreases exponentially, it goes to 0 very quickly. That's why you just pick a big enough number and the computer will tell you, I don't need that many. A minus 1 to the power 100 is like nothing. It's smaller than my 16-digit accuracy anyway, right? You familiar with what I'm saying? Now I'm talking about numerical analysis. You've all done that, right? So for numbers A, which are less than 1, that works beautifully. So if you have a matrix where A minus 1 is small, it's the same. Because you apply the same polynomial to the matrix, and the error is going to be proportional to A minus 1 to the power m. But if A minus 1 is small, A as a matrix, and you probably have seen matrix norms, I'm sure. The spectral norm, the L1 norm, the L2 norm. You probably forgot, they didn't explain that to you. The one that we care about here is the spectral norm. Okay? If A minus 1 is less than 1, you raise that to a very big power, it's negligible. Every Python code will just not even take, right? 0.8 to the power 100 is negligible. So you get rid of it. And that's true for numbers, and it's true for matrices. So that's why this converges for matrices which are of size not bigger than 1. But the Markov matrix, remember, the sum of the rows is equal to 1. That means two things. First of all, 1 is always an eigenvalue, and A minus 1 is very small. So when you raise that with a very big power, you get nothing. So you can approximate it by polynomials very easily, and you all know how to do that. Okay? That's linear algebra. That's why you can do analytic functions of matrices under certain conditions, and for Markov matrices, it's beautiful. This works so well. Okay? And that's why there is a pick your Python package. You give a matrix, raise it to a Markov matrix. So give me the matrix to the power whatever, right away.
So A is the matrix, right?
Yes.
And then the alpha choose k is the generalized binomial?
Yes. It's written there. Yes. It's the term in the Taylor expansion of the power. Right? So this is no mystery. This is all. You feel powerful again? Feeling powerful is good. Yes? So this is what they try to teach you in linear algebra. And it's very important because for us we need it. When we're doing credit, we cannot only do credit for multiples of a year. How silly is that? Imagine going back to assignment number 1. Right? In assignment number 1, you had to take powers of numbers they were not whole numbers, right? Same thing with matrices now. And by the way, if you want to do my assignment number 2, not with the simple Markov model that I explained, but with a real one, then you have to do this. And you need more bonds or more companies. One company is not enough because the company could change from AA to AAA, and then having only the AA information is not enough. You need the AAA information too, and the B, and you need all of them, and you need to calibrate all the companies at the same time. And that's why I ask you to not do that. That's not the objective. I want you to understand it. But for assignment number 2, that's not what I want you to do. Just pick the simple model. Like I told you, I'm very happy with it. Most of you will be very happy with that. Some of you will be working at a credit desk where you cannot do it. You'll be fired if you use that model, all right? But for most others, this is very good. It gives you a very good heuristic of what that is. Okay, so I have a feeling we need a break. Am I right? But we climbed, this is not that it was a very steep hill, but those of you who had learned very good linear algebra, this was very easy. But if you haven't, if you still hesitate when you have a matrix in front of you, then this could have been challenging. So let's take a 5-minute break, okay? Because I'm actually continuing with the same theme. I don't want you to forget about this. I'm not changing themes now. I'm almost done, by the way. I'll finish early today, okay? So we come back in 5 minutes. So I continue. This was a technical stop, because I think this is not hard. This is not hard at all. But if you've never seen matrices in this form, this could have been a little bit daunting. So I want to now have a problem here, which I really would like you to do. So I want to give you a few seconds. I'll give you a transition probability matrix for a credit rating system. And I ask for the cumulative probability of default for a counterparty in year 2, not in year 1, in year 2, if the initial rating is B. Please do it. You can do it in your head. Maybe you need a calculator, but I want you to do it. You just need to multiply that row by that column. You don't need the square of the whole matrix, because you're only looking for that entry there. Okay. Okay, so what I'm going to do now is, so I essentially have finished what I wanted to cover today. I think we're very prepared to understand credit in different contexts. We saw the basics. But I want to give you, for completion's sake, I want to give you slightly complementary perspectives on what we have done now. Nothing new, okay? Just a different perspective. We claimed the hill, now we're gonna look at it from a different perspective. And for that, I want to explicitly tell you what is the Markov model we're dealing with here. This is very important for Monte Carlo simulation and something that will be very important for us next week. So if I start with a certain credit rating now, the credit rating is a number, but we're not going to think of a credit rating as a number. We're going to think of a credit rating as a vector. Never mind that right now my vector is 1 at where I am and 0 everywhere else, because as this evolves over time, my Markov chain will map whichever credit rating I am into a vector which is no longer zeros and ones. So I'm always going to think of my credit rating as a vector, not necessarily as a number or even a credit state, right? And the multiplication by the matrix A, the transition probability matrix, is how I propagate my credit rating from one step to the next. And I can do this many, many times. And the result is going to be the multiplication for the subsequent powers of A to the power n. So after n years, that's going to be my credit rating. So this puts credit states as distributions, not as numbers. And that's very important to do proper credit risk modeling. Okay? Now, I want to say that, first of all, 1 is always an eigenvalue of a Markov matrix because the determinant of A minus the identity is 0. The sum of the rows was 1, so if I remove the identity matrix, the determinant is 0. Therefore, 1 is always an eigenvalue. And there is an eigenvector. That eigenvector is a very important attractor for the process because it says that that credit state is constant. It does not change. See? Every Markov chain has an invariant vector, at least one. For which one is it for credit? If you calculate the eigenvector of that eigenvalue 1, what is it? Well, it's the default state, 0, 0, 0, 0, 1, default. That means that the attractor is the default. Every company eventually defaults. And only when you default, you are at equilibrium. Right? Multiply the matrix is 0, 0, 0, 1 at the bottom row. You take the vector 0, 0, 0, 1. The answer is 0, 0, 0, 1. So it's an eigenvector. And that's the, right? So this has consequences. That means that I have here, for example, a transition probability matrix that I made up. And then I can see how the A rating and the B rating will have a probability of default over time. And it converges to 100%. So in the assignment, you're going to have to do this. In the very simple 2x2, not 3x3. Okay, if you were to do a 3x3 system, you will need to have two companies which are rated differently. That means that you will have to come up with a way to rate different companies. And how do you do that? It's hard. If some of you use TD and Scotiabank as your two companies, well, they're very similar. If some of you use the 407 freeway and the TD Bank, they're very different, right? So either you do the rating of all the companies with a proper model like this, or only one with the model I gave you. You can't do anything in between, either the full-blown or the heuristic, the simple heuristic. And I want you to stay with the simple heuristic. That's why I ask you to do that model that way. But I will ask you to give me the evolution over time, both of the model that we saw here today, as well as the one that we will see next week. And it's going to be different. Those will be different. Will be very different. And that's part of the challenge that you have in the assignment, because you're going to get two different answers to the same question using two different methods. And normally you could write a PhD thesis about that. But that's not what I want, one page. Okay? So we'll see more about that next week. But and here you can see, well, anyway, that's, it's a very simple simulation that we can do. Now, there is something related to all of this, because those of you who like math, I wanted to give you a bit more math. If you're happy with this, you can just now, sit back and relax. But if you want to know the mathematical context in which this lives, this is part of a very powerful theory, some of which some of you may be exposed to. And I remind you that a to the power t, we already showed you how to take powers of matrices, arbitrary powers. They can be written as the exponential of the logarithm of the matrix times t, right? Because it's all analytic functions, and if it works for numbers, it has to work for matrices. And that means that this will be a solution of a differential equation, a matrix value differential equation. In fact, an operator value differential equation. You can do the same thing where the solutions are not just matrices, where they are actually operators. Okay? We have here perhaps hinted at the fact that the operator, like for example, the Laplacian, is like a matrix. And it's very important to understand that analogy between the two. So in this case, the differential equation I have is this one, that the derivative of the of the matrix to the power t is the logarithm of the matrix times a to the power t. So it's a differential equation. It's a differential equation that has that can be written like that. I can just write the initial value and then the equation itself, and this is something that works for every Markov process that I have. And in fact, the Markov process is specified by the derivative of this at zero. You're familiar with this. If I give you a differential equation and I specify the value at zero, that determines the whole evolution. It's the same thing. And this derivative of this process at zero is called the Kolmogorov infinitesimal generator, which in our case is the logarithm of the matrix. So the logarithm of the matrix is the Markov infinitesimal generator. And this is something that some of you may have seen in other contexts. Some of you, if you've done physics, you will know the Fokker-Planck equation, for example, or the Langevin equation. This is very, very advanced. It's a description of generic random processes like Brownian motion and beyond. So what we did for Brownian motion was very sophisticated. This goes even beyond that. We're not going to go there. I just want you to know that it's a theory. There are mountains and valleys beyond where we have been, where some people live, okay, and spend their lives working on those things. And the master equation, which governs the time evolution of the probability distribution of the system. Okay, so that's where things show. This is where the lecture today ends. And now we are completely ready to start the commercial models, which is when you go to work, that's what you will end up using. And there are going to be different versions. What we did here, much more practical, much more linked to financial markets. We will do that next week. We'll do it online. And I wonder if there's any questions.